So if you have to sum up, what are the major reasons for Q1 FY26 GDP growth? Okay, that will be first, substantial increase in government capital expenditure, 52% year over year. The second reason is deflator, and both these factors do not contribute to GDP growth organically. Right? I'll explain how. The first is the government capital expenditure, as we already discussed. It shows a growth of 52% year over year. Is it really 52% growth or really 52% expansion? No. Is it organic? No. Why? Because Q1 last year, in Q1 of FY25, government was not able to spend on Capex because of Lok Sabha elections. There was contraction in growth. There was contraction of 35%, because of which this growth of 52% is showing substantially higher because of 35% contraction. So it is not an organic growth. It is not an organic contribution to GDP. So the second reason for GDP growth is deflator. Is because of deflator, the GDP growth looks higher to that extent. So is that an organic GDP growth? No. Okay. So first I'll explain what is deflator. So as we know, there are two ways to measure GDP growth: normal GDP growth and real GDP growth. What is nominal GDP? It measures the value of goods and services at current prices. That is, at today's market prices, which means it includes inflation. It includes the price differential. And what does real GDP does? It adjusts for inflation or deflation, and therefore it drives away the price differential, and it shows the volume of production. So what happens is, to go from nominal to real, we use something what's called as GDP deflator, or it is simply the price effect remover. So in case of inflation, what happens is, that is, if the prices are rising, the nominal GDP looks bigger than the real GDP. And in case of deflation, that is, if the prices are falling, nominal GDP looks smaller than the real GDP. So if you look at this quarter's data, that is Q1 FY26, nominal GDP growth is 8.8% and real GDP growth is 7.8%. It means what? The price effect is just 1%. The price differential is just 1%. Okay. So GDP deflator, which is equal to the price effect remover, is equal to 1%. Simple meaning is very low inflation, almost flat prices. Whereas if you see for Q1 FY25, the nominal GDP growth was 9.7% and real GDP growth was 6.5%. So difference is 3.2%. So price effect remover or GDP deflator was 3%, which means what? Prices were increasing more strongly then. Okay, so in Q1 FY25, if you see, the price differential was 3.2%, and now this year, Q1 FY26, the price differential is just 1%. It means the price effect or deflator is very small this quarter, just 1%, which means most of the nominal growth is real growth, except for 1% differential. Whereas for last year in Q1 FY25, the price effect or deflator was around 3%, which means what? Higher price differential or inflation of 3% ate into the numbers, because of which real GDP growth looked smaller or lower. So you see, because of low deflator, just 1%, real GDP growth this quarter looks stronger. In case of high deflator, that which was the case in Q1 FY25, the real GDP growth looks weaker. So if inflation or GDP deflator or price differential would have been high, the real GDP to that extent would have been lower in this quarter also, similar to one of FY25. Since price differential is not high, therefore GDP looks higher to that extent, and which is not a real contributor to real GDP growth. So after the Q1 FY26 GDP numbers have come out, many are probably surprised or a little confused, and there are many reasons for the surprise or confusion, so we'll list out that. One, there is opinion that just before a month the GDP growth numbers were a significant 1.3% lesser than what it has been portrayed now, that is 7.8%. So even if you see manufacturing sector growth, it has grown by 7.7%. Now thing is, last year Q1 it was 7.6% growth. That means the sector had done well last year. So the base point or the comparison point was already high. So usually when the base is high, it is hard to show so much growth so much strong growth again, because you're comparing against an already hard-earned strong number. So 7.7% growth this quarter on the top of last year's Q1's growth of 7.6% sounds too good to be true for some experts. Okay. Also, nominal GDP growth of 8.8% this quarter means that the inflation is just 1%. So according to some experts or market analysts, they think this is not correct and that the price differential has not been covered adequately. So these were the factors why some experts or market analysts think that true picture has not been portrayed or it is not very clear. Now coming to another issue, manufacturing segment, if you see, it has grown by 3.3%, whereas in Q1 last year it grew by 4.3%. Steel segment, it has substantially declined this quarter, and private vehicle sales, it has declined growth of 5.4%. Commercial vehicle sales is down by 0.6%. Railway freight has shown a growth of 2.5% compared to 5% in last quarter in Q1 of FY25. And air freight, it has shown 5.4% growth compared to 13.9% growth in Q1 last year. And two-wheeler sales this quarter, it has contracted 6.2%, and three-wheeler sales, it grew very namesake marginally at 0.1%. So just to explain, as you can see, the manufacturing segment as measured by IIP, that is Index of Industrial Production, this has grown by 4.3% in Q1 FY25, and this quarter, that is Q1 FY26, it has grown by 3.3%. Whereas if you look at the gross value added numbers, manufacturing sector has contributed at a much stronger 7.7%. So why this gap? Why this difference? Okay, this is because IAP measures just the quantity as to how many goods were actually produced. But the gross value added, it measures the actual value created. This 3% or 3.3% increase, it only captures volumes. It does not capture price rise and cost reductions. Right. So GVA captures this raise prices and cutting in cost. So essentially what it means is that even if factories just made 3.3% extra goods, the value added to the economy was much higher at 7.7%. Also, just to add data that I missed adding on earlier, FMCG sales volume, if you see for Q1 FY26, urban India has contributed to 6% growth and rural India has contributed 8.4% growth. So rural India has relatively contributed more than urban India. So what is the path ahead, or what we should look forward? The first is that the government spending might reduce, because we've seen government has already spent a huge quantum of their expenditure quota in Q1 FY26 itself. So when that slows down, that will show its effect on the GDP numbers coming forward. Second is GST reforms by the government. Rate cuts will boost consumption, which will in turn translate to GDP growth. But government has to bear the brunt of foregoing so much tax collections around. But the other way of looking at it is that such simplified reduced rates will hugely boost consumption. That will contribute to the economy. Plus collections from ultra luxury and sin goods will further add on to making good contribution to the economy. That will translate to GDP growth. GDP reforms by the government to cut prices, and therefore consumption will increase, and therefore it will somewhat neutralize the effect because of Trump's tariff impact. Although this will boost consumption, that will also perhaps help in GDP growth, but to what extent, that is something that we need to watch out for. So we'll have to see how that turns out. So coming to Trump's tariff issue, so additional Trump tariff effect that has started its impact from August 27th, 2025. So that will start showing its effects from this quarter. And if it's going to continue, the effect will be there for so many quarters as well. So earlier there was worries that exports will be affected. Many industries that depends on exports will be affected. So many jobs and livelihoods would be at risk, would be lost, and that will affect consumption sector, and that will in turn affect GDP growth. And because of which the economist had predicted that Trump's tariff on export can affect GDP growth of up to 1%. But now that we are seeing US own towards India has somewhat softened, after US is seeing improved strategic friendships between India, Russia and China, their tone has somewhat softened, And also the way US economists are strongly giving opinions that Trump shouldn't further ruin US strategic relationships with India, and that Trump should try to mend things before it's too late. And after Russia's Putin is going out of his way to defend India publicly, and that keeping on giving this further trade discounts, and after the US court has called out Trump's tariff to be illegal, all this, because of all this, it is likely that this extra tariffs imposition will not sustain in the long run, and therefore there isn't too much to worry. But even court ruling or the final verdict regarding this extra tariff imposition is expected to come out in early 2026, that is probably by Feb 2026. So what it means is that till such time extra tariffs will be applicable, and that will show its effect on Indian economy. That will in turn show its effect on GDP growth as well. And therefore, it is a likelihood that Trump's additional tariffs will be cut down, and therefore GDP might continue in a normal pace and not at a very subdued pace. Okay. Another factor that we need to watch out is, in spite of higher public spending, the private capex is showing weakness. So that is something that we need to see. And next is the repo rate cut. So experts are of the opinion that repo rate cuts is unlikely because inflation is at its 8-year low in India, and GDP growth is the highest in 5 quarters. So what is repo rate? Repo rate is the interest rate at which RBI lends money to banks. So cutting repo rates, it makes loans cheaper, it boosts spending. And when repo rates are increased, what happens? Loans become costly and inflation is controlled. Right now, India's inflation is at its 8-year low. That means prices are not rising fast, and GDP growth is strong. It is the best, it is the highest in 5 quarters. Since the growth is already strong, the RBI does not need to cut rates to support the economy. The common thinking is that with such strong numbers, the RBI will prefer to wait and watch rather than step in and cut repo rates. Because economy is doing well, inflation is low, so RBI need not step in and support the economy by reducing repo rates. Right. So earlier the thought process was that Trump's tariff impact will affect exports, and therefore economy would slow down, and therefore government will step in by cutting repo rate. That would make loans cheaper, and that would boost investment and demand. But since the data as of today is that inflation is at its 8-year low, the GDP is highest in 5 quarters, even if growth in GDP is not 100% organic, as far as it appears, it is a good growth number. And even GST reforms are being made to boost demand, to boost consumption, and to somewhat take off Trump's tariff impact. Plus, good news has come in for India as to US court has ruled out Trump's tariff implementation as illegal, and US ambassador in India is trying to mend relations with India as far as it appears. So all these are good indications for Indian markets, and therefore it will turn to India's favor, it looks like, and there will not be very adverse impact of Trump's tariff implementation, and therefore repo rates might not be cut. So that's it for this video. Thank you so much for watching, and subscribe for more such videos.